What is saying, people? TWP back with a bang. Here I am to bring you guys another video today. So today I'm actually going to do you guys a huge favor. Pretty much what happened is 2 days ago I did a live webinar on options trading. Pretty much just in regards to options contracts, a few things you need to know, information on options contracts, options chains, that sort of thing. But I know a lot of you missed it, and a lot of you have reached out to me to do it again. Was it recorded? That kind of stuff. No, it wasn't recorded, but decided in my free time I will record the webinar, show you guys some of the things I'm looking at and what I look for when it comes to options. But I would like you to do me a huge favor. Drop me a huge thumbs up, a much appreciated thumbs up. It is completely free, so you'll be happy to know that. And if you're new around here and you would like more videos like this, then feel free to subscribe. No pressure. Again, it's free. Now, one thing to know when it comes to options is options are not stocks. Options and stocks are two different things, right? So first you have the bid, or you have the bid and the ask. The bid is what people are trying to buy this option contract at. It says 42 cents, right? And then we have the ask. It says 45 cents. So in reality, because you have to multiply this by 100, because we're doing options, not shares, that would be $42, and that would be $45. So people are trying to ask, can I buy this for $42? People are saying, I'm selling it to you for $45. It's a bit of negotiation, which brings us on to the mark. The mark is 44 cents. That's kind of like the middle price, the middle ground right now. Then you have the IV, the implied volatility. I'll get into that a little bit later, but at least you know that IV stands for implied volatility. So this means you see 63.53%. This means there's there's an expected move of 63.53% either way, up or down. You've got the previous close. Previous close is where this contract closed at the previous trading day. You've got the high. The high is the highest it was today, the highest price it was today. You've got the low, which is the lowest price it was today, 31 cents. Again, that's $31 because we multiply it by 100. Then you've got the chance of profit. So the chance of profit is 27.44%. It's around 27% chance that you end up in profit. We've got the volume, 396. Now the volume is the activity and liquidity of the contracts. So it's pretty much how easy it is to get in and out of that trade. How many buy and sell orders are happening during that period. Higher volume means it's easier to get out of the trade. Lower volume means it's a little bit more difficult to get out of the trade. But this is purely for the option itself. If you're looking at actual markets and shares, the volume will be a lot higher number than this. So you need to just realize that all of these numbers are in regards to this specific options contract. And now we've got open interest. So the open interest is the number of options contracts that are still open. So when you buy, you'll be a part of this open interest. So I also want to just let you guys know that I have the stock option starter pack. Stock option starter pack talks about options in depth. From the terminology to the Greeks, I have a whole section on implied volatility. I have a whole section on how I trade, various trading strategies, what it means to buy a call, buy a put, sell a call, sell a put, the wheel strategy. You got to just check that one out. It is a $99 one-time payment, but it also gives you access to the Discord. So again, check out the stock option starter pack. It's 3 hours worth of content. I'm sure you would appreciate it. Mostly you will be buying options. I sell and buy options, but the reason I sell options is to make money, to collect premium, which we're going to talk about. So there are 4 key components in regards to options trading. 1, the strike price. The strike price is the price you pay when you choose to exercise your option. So if I have an option, which is a $50 call of a stock, and I choose to exercise it, I will be able to receive that stock or shares of that stock at $50. No matter what price it currently is, I can receive the shares of that stock for $50. Even if the stock runs to 5 billion, I can buy the stock at $50 because that is my strike price. 2, the premium. The premium is what you pay up front. So this is what you pay when you buy an option. And it's basically paid as insurance in case the stock moves against you. And if price does move against you, well, you only lose your premium. If you're an option seller, you will receive a premium. 3, expiry date. The expiry date is when your contract will expire. Every single option has an expiry date. Options are not like shares. Shares, I can buy Nike shares today and they never ever expire. Unless Nike goes out of business, of course. But even then, the shares don't actually expire. But each and every option has an expiry date. 4, you have the underlying asset known as the stock. So Tesla, Apple, Microsoft, Amazon, whatever you're trading on, that is the underlying asset. This can also be commodities or futures contracts. In options, we have rights and obligations. If a buyer chooses to exercise his contracts, then the seller has to sell for that price, whatever the strike price was. So when I buy an option, someone is selling to me. If I'm buying, I'm paying a premium. If I'm selling it, I receive the premium. But if as a buyer, I have the right to exercise and actually buy those shares. The seller, on the other hand, is obligated to sell. We're going to do more of these in the future, get more of you onboarded, get more of you helped out, and help more of you become better traders. So enjoy the webinar.